Every time the Fed cuts rates, you check your credit card statement. Every time. You saw the headline, you did the mental math, you told yourself this is the month it finally gets a little cheaper to carry that balance. Every minimum payment, every statement date, every year of watching the number never quite catch up to the news. And every time, you open the app and the APR is sitting exactly where it was last month. Same number, same wall. Here's the part you already sort of know. Your credit card's interest rate is tied to the Fed somehow. Everyone's absorbed that much. The economy shifts, the rate on your card is supposed to shift with it. That's obvious. What's less obvious is that your APR was never one number responding to one thing. It's two separate numbers, stapled together at your bank's discretion, and only one of them has ever actually been under the Fed's control. The mechanism is this. Every card rate you've ever paid is built from an index the Fed effectively sets, plus a margin your issuer sets on top of it. And the margin is where almost all of the real decision-making happens. By the end of this, you won't read your statement as "my rate moved because the economy changed." You'll read it as two signatures stamped on the same bill, one from a committee in Washington, one from a pricing desk at your own bank. And you'll finally be able to tell which signature is actually costing you money. Start with the clean version, because it really is this mechanical. 8 times a year, a committee inside the Federal Reserve votes on a target for overnight lending between banks. Within a business day, the prime rate, the rate banks charge their most trusted borrowers, adjusts by the identical amount. This isn't an estimate. It's been the same formula, Fed funds plus 3 percentage points, since 1994, and virtually every major bank in the country uses it, whether the target sits near zero or up in the double digits, the way it briefly did in the early 1980s. The prime rate isn't something individual banks compete over or negotiate. It's a shared convention, tracked publicly, published daily, moving in lockstep with whatever the Fed just decided. If the story stopped there, every card advertised as prime plus a margin would just be a fixed number riding on top of a rate the Fed steers directly. Cut a quarter point, and every card in the country should shave a quarter point off within a billing cycle. Raise a point, and every card should climb a point. No more and no less. That's the textbook model. That's what most people reasonably assume is happening every time a rate cut or a rate hike makes the news. Here's where the clean model breaks. Your APR was never just prime. It's prime plus a margin, and the margin is not mechanical at all. It's a number your issuer sets based on your credit risk, their own cost of funding, what they expect to lose to charge-offs when borrowers default, what it costs to fund the rewards program printed on the front of your card, and what they've calculated they can charge people who mostly don't switch cards over a single percentage point. Every one of those inputs is a business judgment, not a formula. There's no law connecting the size of that margin to the Fed funds rate. None. The Fed can cut, prime can fall right alongside it, and the margin can simply stay exactly where it is, because nothing in the system requires it to move at all. It behaves less like a rate that responds to conditions, and more like an ability sitting on a cool-down timer that only your bank holds the key to. It activates on the bank's schedule, not the economy's. None of that makes the margin inherently unfair on its own. Pricing for risk is a real function, not a trick. A borrower more likely to default genuinely costs the bank more to lend to. What's worth noticing isn't that the margin exists. It's that it moves in exactly one direction more easily than the other, and that asymmetry has nothing to do with risk at all. It helps to compare this to a home equity line of credit, which is also priced off prime. A HELOC's margin is usually small and fixed at origination, often just half a point to a couple of points over prime. Because the loan is secured by the house, so the bank doesn't need a wide discretionary buffer to protect itself. An unsecured credit card carries no collateral at all, which is exactly why issuers built a margin large enough and flexible enough to absorb losses without renegotiating every account individually. That's not a flaw. For an unsecured product, the margin isn't decoration on top of the real rate. It functions as the entire risk buffer, and buffers of that kind get built wide and released slowly by nature, on unsecured lending most of all. There's also a structural reason the margin sits still more often than it drifts. Since the Credit Card Act of 2009, when a bank wants to raise the part of your rate it fully controls, it has to warn you 45 days in advance. But when an increase comes from the index itself, from prime moving because the Fed moved, no warning is required at all. It just shows up on your next statement. So the layer the Fed steers is built to pass through instantly. The layer your bank steers requires a deliberate, paperwork-generating decision. Guess which one issuers are more willing to make often, and guess which direction it usually runs. Look at the aftermath of the 2008 financial crisis for the fullest version of this pattern. As the crisis unfolded, the Fed drove its target essentially to zero, and prime fell right alongside it, bottoming out at 3.25% by December of that year. A record low it would go on to hold for the better part of 7 years. If cards simply tracked prime, that stretch should have produced the cheapest credit card debt in modern history. Instead, as defaults spiked and issuers braced for a wave of charge-offs, the average margin stacked on top of prime widened sharply, and it never fully retreated once the crisis passed. The floor dropped further than it ever had. The structure built on top of it rose to meet it anyway, and mostly stayed there. Now here's where the asymmetry actually shows up in your money. In February 2020, the Fed's target sat around 1.5 to 1.75%, and the average credit card rate was a bit above 15%. Then the pandemic hit, and within weeks, the Fed slashed its target all the way to near zero, a cut of a full percentage point and a half, one of the fastest easing moves in the central bank's history. Prime followed exactly as the formula says it should. The average credit card rate dropped by roughly half a point, not 1.5, about half. The rest of that cut never reached a single statement. It stayed behind, absorbed into a margin that quietly widened to make up the difference. Now run it in reverse. When the Fed later hiked aggressively to fight inflation, issuers didn't wait for anyone's permission. Rates climbed within a cycle or two of nearly every increase, and margins kept climbing even after the Fed itself paused. That's the pattern in both directions. On the way up, the index does the work, and the margin happily rides along on top of it. On the way down, the index does the work alone, and the margin holds its ground like it never got the memo. This isn't a new instinct. It's baked into how the incentives were built. Go back to that 2009 law that created the 45-day notice requirement. In the months between the Card Act passing and its rules actually taking effect, issuers didn't sit still. Anticipating that margin increases were about to become slower and more visible, many banks moved first, raising rates, tightening credit limits, and closing unprofitable accounts in the months before the restrictions locked in, according to research from the Boston Fed examining that exact window. The same way a studio announcing a balance patch weeks ahead of time sends every player rushing to grind out one last run with the version of the mechanic that's about to get nerfed. The lesson issuers took from that episode wasn't, stop raising margins so aggressively. It was, raise them while the window is still open, and never lower them a day sooner than you're forced to. And with each hiking cycle since, the meta for how much margin an issuer can quietly hold on to without losing customers shifts a little further in the bank's favor, and it rarely resets back down to where it started. Here's the part almost nobody connects back to their own wallet. Say you're carrying $5,000 month to month, close to the national average for revolving balances. The Fed delivers a full percentage point of cuts over the course of a year. Historically, less than a quarter of that point ever shows up in the average card's APR by year's end. Carry that balance, and if 3/4 of the cut never reaches your bill, that's roughly $37 a year sitting on your bank's side of the ledger instead of yours. That number sounds small until you remember it repeats every single year you carry a balance, stacked on top of a margin that was already historically wide before the cut ever happened. And here's what that actually means for how you should think about the number on your statement. Your card's APR was never primarily a referendum on the economy. It's primarily a referendum on your issuer's risk appetite and your own credit file. The Fed only ever explains a slice of what you pay. Two people can share the exact same prime rate in the exact same month and still owe entirely different APRs, sometimes by a spread of 10 or 15 percentage points, because one of them sits in a better margin tier than the other. Slide down a tier or two, a missed payment, a spike in utilization, a card that's aged past its promotional period. And the margin above your prime rate can widen by several points on its own, with no Fed decision involved anywhere in the process. That tier isn't set by the Fed. It's set by your bank, about you specifically, reassessed constantly when it works against you, and almost never revisited in your favor unless you're the one who picks up the phone and asks. That also tells you who wins and who loses when a headline says rates are falling. Borrowers with strong credit and low utilization tend to already sit near the floor of their issuer's margin range. They have less room left to fall, but they were never paying the worst of it to begin with. Borrowers carrying higher balances, thinner files, or cards they've held for years without ever renegotiating tend to sit near the ceiling, and the ceiling barely moves, cut or no cut. The system isn't malfunctioning here. It's working exactly as it was designed to. Risk-based pricing that treats a Fed cut as an opportunity to protect margin, not an obligation to release it. There's a quiet irony in how this tends to get reported. The headline reads as if a rate cut is uniform good news for every borrower in the country at once. Relief is coming. Borrowing gets cheaper. But relief was never going to be evenly distributed to begin with. It arrives fastest for the borrowers who need it at least, and slowest, or sometimes not at all, for the ones already paying the highest rate in the building. Zoom out, and the full architecture comes into view. Every card rate in the country is built from 2 layers stacked on top of each other. The bottom layer is public, mechanical, and Fed-driven. It moves the instant a committee in Washington votes, gets reported in every headline, and gives borrowers a convenient, visible explanation for why their rate is whatever it is. The top layer is private, discretionary, and issuer-driven. It moves only when the bank decides it should, in whichever direction protects the bank's revenue. And it's the layer that actually determines most of what you pay over the life of a balance. The public layer is the one everyone argues about. The private layer is the one quietly doing the arithmetic. The Fed was never setting your APR from Washington. It only ever set the floor beneath it. Your bank has been building on top of that floor for years, adding a little more height after every downturn, and it rarely tears down what it's already built. Understanding that distinction changes how you read every Fed cuts rates headline from here forward. The real question is never just whether the Fed moved, but whether your issuer's margin moved with it, because that's the number actually deciding your bill. If this kind of breakdown is useful to you, that's exactly the kind of mechanism 8-bit economics exists to take apart. No hype, no predictions about where rates go next, just the underlying code running behind the numbers on your own statement. Subscribe if you want more of these, hit like if this changes how you read your next bill, and drop a comment with the gap between your card's actual APR and the current prime rate. It's a more revealing number than most people ever bother calculating. By the time everyone sees it coming, the smart play is already over. Your credit card doesn't really have one interest rate. It has two owners. One sits in Washington and moves in public, on a schedule anyone can watch, argued over on the news the same day it happens. The other sits inside your bank, moves in private, on a cooldown only it controls the length of, and answers to no calendar but its own. You've spent years watching the public one. The private one has been quietly setting your number the entire time.